Hello, it's 10 o'clock on the 1st of December. My name is Jonathan Greenstein, and welcome to today's webinar, Implementing IFPR, a detailed review of the ICARA preparation process presented by Complyport. Today's presentation will be recorded and is delivered by three of Complyport's senior team. The presenters are Peter Wilson, Manager of Regulatory Advisory Services, Panagiotis Antonio, Head of Risk Management and Prudential Support Services, and Panagiotis Vassiliadis, an expert on the IFPR, who will be discussing K-factor requirements, fixed overhead requirements, liquidity requirements, governance and consolidation requirements, and more. At Complyport, we are specialist regulatory compliance and financial crime consultants. Our team are experts in FCA authorizations, day-to-day compliance and regulatory support, as well as assisting firms in meeting the requirements of and implementing new regulation. In addition to their services, Complyport also provides a RegTech solution to firms that supports them with compliance monitoring, the management of documentation, and the internal liaising required for sign-off and financial promotions or gift entertainment, etc., all in an audit-driven environment. Now, before we begin properly, I would like to cover some brief housekeeping points. Either at the top or bottom of your screen, depending on how you have it configured, you'll see a button called Q&A. If you have any questions, please can you ask them there, and we'll try to get through as many as we can at the end of today's discussion. Please do not post questions into the chat function, as this will not be monitored. With this all in mind, I would now like to invite my colleague Peter Wilson to talk to us about the IFPR. Peter.
Thank you, Johnny, for the introduction. We will now try to give a deep dive into the new IFPR regime. Next slide. So, 1st of January is fast approaching for us, for the firms listening in today's webinar, and it'll be front of mind. So for all of us, there's just 1 month for firms to prepare for the new regime. Firms will have received and returned the FCA's setup questionnaire, which will be used by the regulator to upload the new reports, which firms will be required to report. It will also be used by the FCA in the future to request ICARAs, and if you have committed to a date of ICARA, which you have done in setup questionnaire, make sure to keep to it. Next slide, please. Just a quick recap of the IFPR from the FCA perspective. The aim of the IFPR is to streamline and simplify the prudential requirements for MiFID investment firms that they prudentially regulate in the UK. The IFPR will apply to the following groups: MiFID investment firms authorised and regulated by the FCA, collective portfolio management investment firms, regulated and unregulated holding companies of groups that contain either of the above. And there are some other groups as well which are included, which we can talk about later. For a number of firms, this will be the first time that it will have to complete prudential returns or prepare ICARA projections. The IFPR will not apply to PRA designated investment firms. They will remain the subject to prudential supervision by the PRA, and that's approximately 3,000 firms. The rest, which is around about 50,000 firms, come under the FCA, and the FCA has responsibility for prudential reporting. Next slide, please. So the FCA's objectives, and this is from their website, the aim of the IFPR is to streamline and simplify the prudential requirements for MiFID investment firms that they regulate. In line with their objectives and missions, it will refocus prudential requirements and expectations away from the risk firms face to also consider and look at to manage the potential harm, and harm's an important word, firms can pose to consumers and markets. The FCA have made it very clear they will use the IFPR to manage the risk and the harms for firms, consumers and markets. It's not an academic exercise, but a real attempt by the FCA to understand how the firms they regulate, how they operate, and what risks and potential harms they pose to customers and markets. The data supplied in the ICARAs will allow the FCA to be more proactive and intrusive into markets which pose risks to customers or the wider UK financial services industry. Next slide, please. Just a quick recap of what has led to where we are today. The FCA have been working hard on introducing the IFPR, and some key dates. 3 consultations papers, which have been published in December 2020, April 2021, and August 2021. 3 policy statements which have been issued, which have followed the consultation papers, and these were published June, July, and last week in November. And finally, the final rules are available. So if you use the timeline on the handbook, you can see the MiFi Pro rules if you forward date them to January. Next slide, please. So key aspects of the new regime. Firstly, capital requirements change and now will be stated in pounds, one of the first changes of Brexit. So there will be 3 categories, 75,000, 150,000 and 750,000 pounds. K factors have been introduced, which will require firms to capture internal data for reporting in different formats to the previous ICAAP format. Liquidity requirements have been changed. Regulatory reporting, new MIFIR reports, MIF reports being introduced, MIF 005 and MIF 007, which is your ICARA report. The ICARA replaces the old ICAAP and will require firms to maintain and update when prudential or capital requirements change. The FCA emphasised that this is a process rather than once-a-year exercise, and process is important to bear in mind. Prudential consolidation has also been altered, and remuneration policies have been changed. The FCA have published new templates in this area reflecting the new IFPR requirements. And not on this slide, but it's important, wind down plans have become increasingly important to the FCA. In worst case scenarios, where a firm has to wind down, are the plans adequate to ensure an orderly wind down? The FCA will be checking. The FCA will require firms to give some deeper thought than previously, particularly in light of COVID and the pandemic. Firms will be more vulnerable and should have to plan what resources, capital, staff, which are required to wind down in an orderly manner. And finally, the three pillars here, the prudential blocks. The first one obviously is own funds and liquid assets, which will probably be your old pillar 1. The additional funds, the ICARA, which will be the old pillar 2. And finally, your public disclosures, pillar 3, still remain. Thank you, Johnny.
Thank you very much, Peter, for that brief overview of the IFPR. Now, I would like to invite Panagiotis Vassiliadis to carry on the discussion, but before we do, I'd like to ask a question of our audience. I'm going to launch the poll on our screen now and read it out for you as well. If you could please all answer it. The question is, do you know what your new classification under IFPR will be? The answers would be SNI, non-SNI, and not sure yet. We'll give it a few moments for these responses to come in, and then we will share the results on screen. If you bear with us a few more seconds. Okay, so what we'll do now is we will share the responses that we have. I'm going to end the poll and share the results. So we can see the majority of people who are on the webinar today and have responded are going to be a non-SNI firm, 48%, followed by 41% who are SNI. And there are 11% of people who responded who are not sure what they're going to be yet. So thank you very much for everyone who responded, and Panagiotis, over to you.
Thank you, Jonathan. Hello, everyone. I would like to welcome you all to our today's virtual walkthrough to the new Investment Firm's Prudential Regime. Together, we will discuss the key regulatory changes under the new Prudential Regulatory Framework for FCA investment firms. As Peter said at the beginning, FCA introduces a new classification system for all investment firms. All firms will now be categorized into small and non-interconnected investment firms and non-small and non-interconnected investment firms, also known as SNIs and non-SNIs. In order to be classified as an SNI investment firm and benefit from less prudential requirements, an investment firm should meet all of the criteria presented in this table here. Specifically, the assets under management should never be above the 1.2 billion pounds. Client assets handled should be less than £100 million or £1 billion per day for cash and derivatives trades, respectively. Assets safeguarded and administered, client money held, daily trading flow, net position risk or clearing margin given, and trading counterparty default should be zero at all times. And finally, total off and on balance sheet and annual gross revenues should be less than 100 million and 30 million pounds, respectively. Any investment firm which breach any of these criteria should be classified as a non-SNI investment firm and comply with the full provisions of the IFPR regime. The existing capital ratio requirements of 4.5%, 6%, and 8% limits for common equity tier 1, and total capital ratio, respectively, will not be applicable anymore. However, under the new prudential regulatory framework, all investment firms are required to maintain a common equity tier 1 ratio of 56%, tier 1 ratio of 75%, and total capital ratio of 100%. The main difference in the calculation of the capital ratios under the new prudential framework is that the equation for each capital instrument is now amended, and the respective instrument should be divided by the total capital requirement instead of the risk-weighted assets as per the UK CRR. The eligible instruments to be considered as own funds are similar to the UK CRR, and thus there are no significant changes to the calculation methodology. Under the new prudential regime, there are 3 different initial capital requirements amounts depending on the MiFID services each investment firm provides. Initially, we have investment firms which are authorized to offer the dealing on an account, underwriting and or placing of financial instruments on a firm commitment basis, or operate a multilateral trading facility or an organized trading facility. Those firms will be required to have an initial capital of £750,000, while investment firms with no authorization to offer the said services and no permission to hold clients' money will be required to maintain only a tenth of the aforementioned amount, meaning £75,000. All other firms that do not fall in either category will be required to hold a permanent minimum initial capital requirement of £150,000. As regards the risk-based capital requirement for each investment firm type, under the new prudential regulatory framework, SNI investment firms will be required to maintain own funds of at least the highest between the new permanent minimum capital requirement and fixed overhead requirement, while non-SNI investment firms should also take into consideration the capital requirements as calculated from the K factors methodology as well. As regards the fixed overhead requirement, it is calculated as the 1/4 of the investment firm's fixed overhead of the previous year. In order to calculate the respective fixed overhead requirement of the previous year, the latest audited figures should be used, and any eligible variable expense, such as variable remuneration, profit shares, share commissions, and fees payables, fees to tied agents, and other non-recurring costs from non-ordinary activities should be deducted from the overall expenses. So, as you understand, the fixed overhead calculation remains similar to the existing prudential framework of UK CRR. However, the list of eligible items to be considered as variable expenses has been extended to include other items under the new IFPR, such as expenses related to tax and losses generated from trading book activities. The new K factors requirement will replace the current credit risk, market risk, and operational risk, so to calibrate the capital that it is required to cover the current Pillar 1 risk. The respective capital requirement of the K factors methodology will be the sum of the risk to client, risk to market, and risk to firm K factor proxies. However, non-SNI firms will only need to apply the K factors that are relevant to their business model. For example, risk to market and risk to firm proxies will only be applicable for firms that are permitted to deal as principal. Thus, firms without authorization for the dealing on an account will only need to calculate risk to client proxy so to determine their K factors requirement. The risk to client proxy should be the sum of 4 different K factors. We have assets under management, client money held, assets safeguarded and administered, and client orders handled, all of them multiplied by their respective coefficients as per the provisions of the IFPR regime. The risk to market key factor requirement for the trading book position could be calculated either by the net position risk key factor, which is the same as market risk based on the UK CRR, or the clearing margin given where it is applicable. Have in mind that clearing margin given needs prior permission from the FCA. Lastly, the risk to firm proxy should be the sum of trading counterparty default, which is the replacement of the existing counterparty credit risk, concentration risk, and the daily trading flow multiplied by their corresponding coefficients. An initial challenge for all investment firms is to identify which key factors are applicable to their business model and make sure that they have in place the procedures and processes needed so to be able to collect the key factors data needs at all times. Also, and according to the transitional provision number 5 introduced by the MiFi Pro rules, all investment firms should start collecting key factors data from the 1st of December 2021, so today, 1 month before implementation, so to have the available information to calculate the key factors on the first reference date of 31st of March 2021. The definition of the large exposures and the calculation methodology of the total exposure amount with a counterparty remains relatively the same with the UK CRR. Trading book exposures should be assessed, and the additional capital requirements needed should be calculated in case of any excess exposure. Moreover, non-SNI firms must monitor and report any other exposure outside the trading book, such as balance sheet items, cash balances, and revenues from clients to the FCA as part of the new MiFi Pro 005 return on a quarterly basis. Finally, and even though that SNI firms will not be required to report such exposures, they still need to apply monitoring procedures and further assess their concentration risk as part of the new ICARA process. The new liquidity requirements under the IFPR applies to all firms without taking into account complexity and size. The liquid assets should be at least equal to 1/3 of fixed overseas requirement and 1.6 of client guarantees as defined in the MiFi Pro rules. The eligible items to be considered as core liquid assets include, among others, cash, deposits in regulated banks, UK government papers, and money market funds with maximum duration of a month. The aim of this new requirement is to ensure that all firms maintain adequate stock of an encumbered high quality of liquid assets that can be easily converted into cash in order to meet short-term obligations under stressed conditions. The MiFi Pro 7 rule introduced amended general rules with respect to the governance arrangement, new rules related to remuneration and to the establishment of remuneration risk and nomination committees, as well as the new ICARA process and SREP, for which we have a dedicated section in this webinar later. As regards the general requirements described in MiFi Pro 7.2, all investment firms should be well-staffed and their organizational structure should be in line with the provisions of the single management systems and controls rules issued by the FCA. Also, adequate policies and procedures should be established so to ensure that the risks that the firm is exposed to are accurately identified, managed, monitored, and reported to the FCA. Finally, adequate internal controls and mechanisms should be in place, including sound administration and accounting procedures. All those governance arrangements should be appropriate and proportionate to the nature, scale, and complexity of the firm. The new prudential regulatory regime replaces the definition of significant IFPR investment firm with the large non-SNI definition. Any MiFi Pro investment firm with an average of on and off balance sheet items over the 4 previous years more than the limits as described in this slide will be defined as large non-SNI firms and should comply with the additional requirements with respect to the governance arrangement and remuneration requirements. Specifically, and as regards the committees, large non-SNI firms should establish risk, remuneration, and nomination committees. The risk committee will be responsible to advise the management body of the firm on the overall current and future risk appetite and strategy, while the Remuneration Committee must ensure that the policies and practices established are in line with the firm's overall risk profile. And finally, the Nominations Committee's obligation includes the selection of the Board of Directors and other material risk-taker roles. At least 50% of each committee should be non-executive directors, including the chairman. As regards the public disclosures, are a core part of market discipline, providing important information and transparency so to enable markets to work well. The table here provides a summary of the scope of application of disclosure requirements related to risk management, own funds and own funds requirements, investment policy, governance arrangements, and remuneration. All disclosure requirements apply to non-SNI investment firms as well as to SNI firms that are issuers of an additional Tier 1 instrument, except from those that are large non-SNI firms, which are also required to comply with the investment policy requirement disclosure. All other SNI firms will only be required to disclose a small number of qualitative and quantitative information on remuneration requirements only. Moreover, non-SNI commodity and emission allowance dealers will be exempted from the obligation of disclosure for the next 5 years since the implementation. Further than that, and as regards the environmental, social, and governance disclosure requirements, also known as ESG, which will affect a number of FCA investment firms, the FCA decided that it would be prudent to wait and consult on ESG disclosures at a later stage. Thus, on the 3rd of November 2021, issued the discussion paper 21.4, seeking the initial views on disclosure requirements under the new sustainability disclosure requirements rule, and the deadline for responses will be the 7th of January 2022. The FCA aims to issue the respective consultation paper regarding ESG in the second quarter of 2022. As regards prudential consolidation supervision, it will apply to all investment firm groups, except to those that FCA has granted permission to use the alternative approach of group capital test. We will discuss about this new concept in the next slide. An FCA investment firm group will comprise of UK parent entity and relevant subsidiaries, where at least one entity within the group is an FCA investment firm, either the parent entity or a subsidiary entity. Parent entity could also be UK financial holding or a mixed financial holding company, while a relevant subsidiary can be an investment firm, a financial institution, an ancillary services undertaking, or a tied agent. The responsibility of the group to comply on a consolidated basis will rest with the parent entity of the group, even if it is a regulated entity or not. The group will be required to calculate capital requirements on a consolidated basis, and the parent entity will be responsible to ensure that it has in place the adequate consolidated financial resources to comply with the group requirements.
Thank you very much for that. Now, we have two more quick questions for everyone. The first one, we'll launch the poll on the screen now. Does your firm fall under consolidation supervision as per the IFPR rules? The possible answers for this, as you can see, are A, yes, B, no, or C, not sure. And what we'll do is we'll give it a couple moments for more people to respond to this. Few more seconds. Okay, so what I'm going to do now, we'll end the poll and share the results. So we can see here that 55% of people who've responded said that their firms do not fall under the consolidation supervision as per the FCA rules, where 26% said yes. Now I'll stop sharing this and we'll launch the next poll. If you bear with me 2 seconds, we'll get it on screen here as well. The next poll is, are you going to apply for GCT permission? The possible answers are A, yes, B, no, C, I have already applied, and D, not applicable. And we'll give it a couple moments for people to put their answers in. We'll share it and then we'll carry on with the presentation. All right, let's end this poll now here and share the results. So 45% of people said it's not applicable to them, whereas 40% of people said they are not going to apply for GCT permissions, and 14% said yes, that they will. So thank you very much for everyone who has answered those questions. And thank you very much for the presentation so far. And now we will pass across to Panagiotis Antoniou, who will carry on the presentation.
Hello, Jonathan.
Sorry, bear with me 2 seconds. Technical issue. There we go. Panagiotis Vasiliadis. Sorry, it's back onto you. Yeah.
Okay. As we said earlier, the group capital test is defined as the alternative approach to the prudential consolidation of an investment firm group. Its purpose is to ensure that the firm has in place adequate regulatory capital, so to ensure that its capital investment in its subsidiaries and ensure that the capital adequacy position of the group is in a well place. The parent entity of the group would apply for permission to use this alternative approach, given that the group has sufficiently simple structure and there is no significant risk of harm to others, from the exception of the group to fall under full consolidation supervision. Although the sufficiently simple structure and risk of harm to others are not defined in the final rules issued by the FCA, the applicant will be responsible to explain to the FCA through its application the reasoning behind the decision that the firm is eligible to apply the group capital test instead of the full consolidation supervision. The parent entity of an investment firm group granted the permission to apply group capital test will be required to maintain sufficient own funds, so to cover the sum of the book value of the holding subordinate claims, as well as the total amount of contingent liabilities of each relevant subsidiary, as defined previously, within the group instead of applying the full prudential consolidation requirement. The FCA introduced a single suite of IFPR reporting returns for all FCA investment firms, so to avoid the complexity on which returns are applicable for each type of entity under the current regime. This list here summarizes the applicable reporting return that SNI and non-SNI investment firms are required to submit, as well as the frequency of the return. Non-SNI firms will be required to submit all of those returns, while SNI firms are exempted from the obligation to submit the two returns related to the concentration risk. The most important change under the new reporting requirement concept is the format of the returns. Upon implementation of the IFPR, core returns as well as XBRL files will not be required by the regulator anymore. Also, FCA returns exempt FSA 029 and FSA 030 will cease to exist. Firms will be required to submit the returns mentioned in this table here only. All returns shall be reported to the FCA via the Reg Data reporting system in an XML format where it is needed. That's all from my side. Thank you, Jonathan.
Thank you very much for that presentation. Now, as you can see in your screens, we have another question for everyone in the audience today. So I'm going to launch this one as well here. The question is, which part of the new regime concerns your firm the most? And this is actually a multiple choice question, so you can select more than one answer. The possible answers for this, as you can see, are the new ICARA process, new capital and liquidity requirements, MiFi Pro remuneration code, prudential consolidation and group capital test, and the new MiFi Pro financial reporting. Let's give it a few moments for these responses to come in, and we'll share the results on screen. Okay, so let's share the results here now. So we can see that the new ICARA process is one of the key concerns that most people are facing in terms of the new regime, followed not so closely by the new capital and liquidity requirements. and then the new MiFi Pro financial reporting. So what I'll do is I'll stop sharing this. And with these responses in mind, we will now carry on today's session with Panayiotis Antonio, who is going to be talking about the ICARA. Panayiotis, I think you might be on mute. If you could please unmute yourself.
Yes, sorry about that. Thank you, Jonathan, and hello, everybody. One of the most significant change in the new prudential regulatory regime is the replacement of the ICAAP by the new internal capital adequacy and risk assessment process, ICARA. From January 2022, the FCA will require all investment firms to complete the ICARA process. For some, the ICARA process replaces the ICAAP, while for others it is established to be like, for example, 1,000 firms that are currently exempted from this process. Firms must review their ICAAP process at least once every 12 months and immediately following a material change in the business operating model. For example, a material merging and acquisition activity, the launch of a new product, or a business line. MiFi Pro 7, as is published in the final rules issued by the FCA, provides an overview of the baseline obligations and the key principles under the new concept of ICARA, as well as the rules and guidance that MiFi Pro investment firms need to apply in this process. The new MiFi Pro rules explains the process to be followed for the implementation of the new ICARA, a summary of the new context of the overall financial adequacy rule, OFAR, which will be part of the conditions 2.4 appropriate resources, the key concepts, the review process and the documentation of the ICARA, the early intervention and notification rules as introduced by FCA, the responsibilities of the firm's governance and single management, the new replacement of the current FSA 019 return and the new ICARA questionnaire, the consolidation supervision and the option to prepare ICARA on a consolidated basis, as well as the process to be followed by the FCA for the verification of the report known as SREP. The principles that are abided by the ICARA are, as regards the firms, we need to identify the risk that the firm is exposed to and assess the potential harms to clients, markets, and the firm. The ICARA process is the centerpiece of the firm's risk management processes, like risk identification, monitoring, and mitigation, business planning, forecasting, and recovery options. It outlines the responsibilities of the senior management to ensure the appropriateness of the firm's governance and risk management. As regards the intervention points, the FCA will intervene at given intervention points if FCA investment firms fail to act appropriately or their actions prove unsuccessful. FCA investment firms must notify FCA where the level of own funds or liquid assets fall below these intervention points. The ICARA process should be proportionate to the nature, complexity, business of each investment firm. Now, even though there are so many similarities between ICAAP and the ICARA, there are some significant differences. Specifically, in the ICAAP report, there is a pre-specified list of risk categories that the investment firm should focus in order to determine the applicable Pillar 2 risks, while in the ICARA, the investment firm should focus on their business model, the activities, in order to identify the risks that are material for them. Moreover, investment firms in the ICAAP should assess their exposures according to the provisions in the UK CRR, while in the ICARA investment firm should focus on risk to the financial adequacy from potential changes in the book value of assets, changes in the value of trading book positions, and losses from potential failure of counterparties. In addition, MiFi Pro investment firms should consider the risk to themselves in light of the effect they may have upon their clients and the markets they operate in. Finally, the ICARA should also include a liquidity adequacy assessment process. The ICARA process includes certain steps to identify, as we have said, and monitor the harms, to operate systems and controls to identify all material potential harm, consider and put in place appropriate financial and non-financial mitigants to minimize the likelihood of crystallization or impact of this material harm, forecast capital and liquidity needs, both on an ongoing basis and where they have to wind down. This must include expected and stress scenarios to determine appropriate and credible recovery actions to restore own funds or liquidity resources where there is a risk of breaching threshold requirements that is tied to specific intervention points. To set out entity-level credible wind-down plans, including timelines for when and how to execute these plans, where in the absence of adequately mitigating risk through systems and controls, the investment firm assesses that additional own funds and liquid assets are required to cover the risk. Now, the FCA investment firm's responsibilities under the ICARA will be to monitor and address both risk that it faces and harm it can pose to the clients. The investment firms, when identifying harm, will be proportionate to the amount of harm posed. This means that the SNI firms should do a lower level of analysis than non-SNI firms. Larger trading firms will carry out a significant amount of analysis. Now, the FCA provided examples of harms to clients and markets in the Annex 1 of the MiFi Pro 7. Some of them are breach of the investment mandate, resulting in clients being exposed to risk outside of their specified tolerance, or to investments which are otherwise unsuitable for their objectives. Trading or dealing errors that result in losses to clients. Corporate finance advice which results in a legal claim against the firm. Losses to clients caused by the activities of the firm's tied agents or appointed representatives for which the firm is responsible. Failure to comply with any applicable provisions of CAS, resulting in potential losses to clients. And provision of unsuitable investment advice, for example, in relation to pension transfers or investments, resulting in clients suffering losses. It is not possible or appropriate to mitigate every risk an FCA investment firm faces or harm it can pose to clients or markets. However, the firm should consider through the ICARA process the appropriateness of the different measures, financial and non-financial, it can take. All investment firms should approach this assessment using the following steps. Consider the risk before any controls are taken into account. Assess the significance of the risk and what controls are in place to mitigate them. Assess how much residual harm remains after applying the controls and determine the necessary financial mitigants on that basis. Investment firms may make use of the non-financial mitigation where appropriate. For example, an FCA investment firm that is particularly dependent on an IT platform for its revenue generation might improve its backup systems and servers to increase its resilience and minimize the risk of outages. However, that one has identified that a particular risk of money laundering and consequent regulatory penalty or sanction might put additional oversight and checks in place to strengthen its anti-money laundering processes. The purpose of the FCA investment firm setting out its business model and strategy is to help to understand its vulnerabilities as a profit-generating operation. Risk posed to an FCA investment firm's capacity to generate sustainable profits have a clear impact on its ability to maintain adequate financial resources. Investment firms should conduct a forward-looking assessment of capital and liquidity requirement as part of their business, capital, and liquid assets planning. This must include an assessment of how a severe but plausible economic stress could affect its ability to meet the OFAR. All firms should set out reasonable assumptions that underpin chosen stress scenarios and the impact on individual business lines and portfolios, as well as the firm overall. They should also take into account any breaches in the ICARA process and apply quantitative, that means capital, and qualitative management actions or controls to mitigate the impact of these scenarios. For larger or more complex business, for example, larger trading FCA firms, they should conduct reverse stress testing to identify a range of adverse circumstances that would cause their business model to become unviable and to assess the likelihood that this will occur. The outcome of the stress test is indicated in this table, where is an example of how a firm might analyze and record the outcome of stress testing using the guidance Annex 1 of MiFi Pro 7 that is potentially relevant to all firms based on the heat map. For example, each risk event should be assigned with the applicable probability of happening and the respective mitigation action, either a financial or non-financial, that is applied. Now, the recovery planning that is incorporated in the ICARA must identify quantitative and, if appropriate, qualitative indicators that provide an early identification that the firm is running into capital or liquidity funding difficulties. It also set out credible management actions the FCA investment firm would take linked to these indicators to try to improve the situation. The recovery planning should be linked with the business model and forecasting scenarios. It should have a reasonable likelihood of success in the context of the anticipated wider economic and business environment, and set out the required governance arrangements to allow for executing the recovery action and likely impediments so that it requires a regulatory clearance to go ahead. The wind down planning is one of the most important topics in the ICARA process. The next part of this presentation is description of the process of the wind down. The wind down is initiating with the board of directors deem the operations of the firm to be inadequate and decide to stop them. The period of the wind down, the firm should use adequate resources to close all its ongoing obligations and costs arising from the wind down process. This process objective is to identify steps, resources, and solutions needed to ensure an orderly wind down will happen with no negative impact on both clients and market participants in general. All these will be leading to the determination of the capital and liquidity requirements calculation. Initially, the firm should identify all scenarios that could affect the financial viability severely, from monetary factors such as liquidity constraints due to decrease in operational activity, and non-monetary factors such as inadequate supervision by the management. Another important step is to have plans in place to ensure an orderly wind down of their existing business will follow in case of closure of the investment firm. Furthermore, the assessment of the adequacy for financial and non-financial resources to support an orderly wind down should follow. Finally, taking into account all the above processes for risk identification and mitigation should be in place to avoid obstacles to an orderly wind down. The contents are placed in these slides. What is the wind down planning, the time horizon, and the time and the people involved in the planning process? The wind down scenarios, what make a firm no longer viable? The effective risk management, making decision to wind down, the impact assessment, and who will be affected by a wind down. An operational analysis, what happens during this process, the resource assessment, and the cancellation of permission when it goes to that point. Now, the overall financial adequacy rule, OFAR, establishes the standard to determine if an FCA investment firm has adequate financial resources. OFAR will require the FCA investment firm at all times to hold adequate own funds and liquid assets to ensure that it can remain viable throughout the economic cycle with the ability to address any potential harm from its ongoing activities and to allow its business to wind down in an orderly way. The own funds threshold requirements and the liquid assets threshold requirements will be determined by the FCA investment firm through the ICARA process. This will represent the FCA investment firm's view of what is required to meet the OFAR, unless FCA advises otherwise. Not meeting these requirements will be evidence that the FCA investment firm had breached the threshold conditions. The MiFi Pro 7 of funds requirements are built around the permanent risk capital, the fixed overhead, and for the non-SNIs, the K factor. The fixed overhead is a proxy for the amount of own funds all investment firms should hold to allow them to initiate wind down in an orderly way. The K factor is the amount of own funds required to cover the risk of harm from the ongoing operation of the firm's business. And the permanent capital is a flat minimum required to underpin the fixed overhead and the K factor. Unlike the fixed overhead and the K factor, the permanent capital does not scale with harm. Meeting the basic requirements alone may not be enough to mean that they are meeting threshold conditions. This will depend on the size, the business model, and complexity of the FCA investment firm's activities. An FCA investment firm will need to estimate the financial impact of any harm that is not covered by its permanent capital, fixed overhead, and K factor requirements. This will help to determine the overall amount of the own funds that will need to hold to meet the OFAR. This will be its own funds threshold requirements and will need to meet these requirements at all times. If it does not, that will be in breach of the threshold requirements. The investment firms will set their own funds threshold requirements at the higher of the permanent capital and the own funds necessary to cover harms from ongoing operation, that is denoted as A, and the own funds as necessary for the wind down, that is denoted as B, and this may be set as a higher amount. The basic liquid assets requirement is based on FCA investment firms having a minimum amount of core liquid assets that will allow them to begin the wind down in an orderly manner. Meeting these requirements may not be enough that they are meeting threshold conditions. This will depend again on the size, business model, complexity of the FCA investment firm's activities. The investment firm will need to determine if it should hold additional liquid assets to fund its ongoing business and ensure it can wind down in an orderly way. This total amount will be the liquid asset threshold requirements, and an FCA investment firm will need to meet at all times. If it does not, it will be in breach of the threshold conditions. The investment firms will set their liquid assets threshold requirements as the sum of the basic liquid assets and the higher of the additional liquid assets necessary for any given point in time to fund the ongoing operations, taking into account potential periods of financial stress during the economic cycle, and the additional liquid assets required to begin its orderly wind down, taking into account the inflows of the liquid assets that can be reasonably expected to occur during this wind down.
Thank you very much. Now we have another quick poll for everyone here. We launch it on our screens. The question is, which of the components below do you believe is key to the preparation of the new ICARA process? And again, this is a multiple choice question. The options are stress testing, wind down planning, risk identification and mitigation, the overall financial adequacy rule, OFAR, or other. And as with the other polls, we will give it a few moments for more people to respond before ending and sharing the results. All right, let's end the poll here and share the results on screen. So we've seen 74% of people have identified that the risk identification and mitigation is key to the new ICARA process, followed by the wind down planning. And then stress testing and OFAR actually are tied 36% here. So thank you very much to everyone who has responded. I will stop sharing this and pass back to Panagiotis to continue the presentation. Panagiotis, you're on mute.
Yes, thank you, Jonathan. An indicative list of components for the ICARA report is presented here. Starting with information that is similar to the previous report, ICAAP, the business model and strategy should be present in the report, including any material changes to the scope of actions of the firm. The stress testing should be carried out with a forward-looking perspective for both liquidity and capital. A procedure testing for the effectiveness of the risk management process should be conducted with a section being taken into details of each distinctive part. The overall financial adequacy rule should be covered for both liquidity and capital processes. The wind-down planning should be an elaborate exit plan for the firm to discontinue its operations with no impact to its clients. The risks that pose material harm to the firm, clients, and market should be identified, assessed, and have mitigation procedures in place. Lastly, the substantial changes in the ICARA process should be conferred in a concise manner, and also the implications to the financial adequacy of the firm should be explained. The early warning indicator, that is only for the own funds, is sent by the firm when the own funds resources fall to within 110% of the own funds threshold requirement or as required by the FCA. This provides the FCA with an early warning indication that the firm would be facing risk to its financial resilience. At this point, the FCA would expect firms to have taken any relevant actions in their recovery plan. For example, if a firm's recovery plan identifies that the own funds resources failing below 115% of the threshold requirement is a trigger for management consideration of various recovery actions. The FCA would expect to see evidence that has occurred at this point. If the FCA has specific concerns about the firm's ability to continue to meet its threshold conditions and the credibility of its proposed response, the FCA will intervene. For example, the FCA may request that aspects of the recovery plan are triggered, the firm cease discretionary capital distributions, or that the firm provides the FCA with enhanced reporting of its situation. It is important that the senior management's responsibility for the ICARA is clearly understood. The ICARA process is central to the investment firm's management of the risks that they face and pose to others. The ICARA process brings together planning and forecasting, risk identification, assessment and mitigation, recovery, and wind-down planning. It is the responsibility of the senior management to ensure the process meets the FCA's expectations. The regulator clarified the risk management responsibilities under the senior management regime. The governing body must review and approve the content of the ICARA documents within a reasonable period after the review has been completed. The ICARA process is viewed as the key requirements of the regulatory systems for investment firms, senior managers, directors, executive and non-executive to take an active role in contributing to the required analysis, embedding the requirements in the business areas. A new ICARA questionnaire reporting template, MiFi Pro 007, is now required, will replace the current FSA 019. The ICARA questionnaire includes a breakdown of the assessment of the additional funds into the identified harms and questions of the firm's business model. The firms inform the FCA of the proposed dates of the submission of the ICARA questionnaire through the IFPR setup questionnaire. This enabled the firms to set their own ICARA reference dates, the date on which data for the ICARA review is pulled, the ICARA review date, and the ICARA submission date for submission of the form MiFi Pro 007. Although the FCA expects the time between these dates should be reasonable rather than too long, a firm can notify the FCA to amend the MiFi Pro 007 submission date as long as there is no more than 12 months between submissions. The investment firms that have been set an individual capital guidance, or the ICG, or the individual liquidity guidance, to contact the FCA to discuss how they can transition to the new threshold requirements, and they need to submit the MiFID 007 for the first time by 31st March 2023 at the latest, as in the policy statement recently issued. If a significant change has occurred in the firm's business model or operating model, the firm should carry out a review promptly and submit MiFID Pro 007 within 20 business days after the firm's governing body has signed it off. For example, if the firm is launching the material new product or a business line, or is merging with another business, the firm, as part of the preparation for those events, should analyze the impacts on the ICARA process. Many FCA investment firms are part of larger groups, and some groups may contain several investment firms. The ICARA process should be consistent with the basis on which they manage their business and risk their day-to-day business activities. Investment firms that are part of investment firm groups have the option to conduct the ICARA process on a group basis unless FCA gives specific direction otherwise. If that reflects their wider risk management framework, if FCA is not satisfied with how the ICARA process is being operated or documented on a group level, it may ask for it to be done on an individual firm basis. A group granted permission to apply the group capital test would not be required to operate the ICARA process on a consolidated basis. In any case, each investment firm must comply with the OFAR on an individual basis, and any additional own funds or liquidity resources required should be allocated to the individual entities. Each entity must also have its own specific wind-down plan, including triggers. Own funds and liquidity intervention point notifications will apply on an entity basis. As part of the ICARA process, the investment firm should also consider any material risk from membership of their group. Where risks are managed on a group basis, the risk management must be done either on an entity which is subject to MiFi Pro, whether itself or another MiFi Pro investment firm in the group, or the firm's UK parent entity. It cannot be undertaken by any type of regulated or unregulated firm. The ICARA document must be approved by the governing body of the entity which carries out their risk management. The groups with multiple FCA investment firms can produce one combined ICARA document that sets out how risks are managed on a group and individual entity basis. It should also explain how each individual entity complies with the requirements that are applied to it. This includes how each individual entity complies with the OFAR and its wind-down planning. This is because the solvency of the FCA investment firms is assessed on this basis, and wind-down happens on an individual entity basis. The SREP, the Supervisory Review and Evaluation process, is used to ensure that relevant markets function well. It's a process and assesses whether the FCA investment firm continues to meet threshold conditions and assesses compliance with the OFAR under the IFPR. The FCA will use this SREP following a harm-led approach. Intelligence will be gathered from a range of resources and the data provided in the ICARA questionnaire. FCA may still apply a minimum SREP cycle to certain firms which present a higher risk of harm.
Thank you very much for that. Now, this now concludes the formal presentation section of the webinar, and I'd like to open up to our audience to see if anyone has any questions for our panelists. We've seen a lot of questions come in, but whilst we wait for a few more, I'll be launching one final poll for people to answer. Whilst you're answering this, I do note that we are running, or we will be in a moment running over time, and we are happy to stay a little bit longer to answer as many questions as we possibly can. Whilst this poll is running, one further thing to mention as you wait for more questions, we will be offering a PDF of the available MiFID Pro application forms for your convenience. Now, to get hold of this, please can you email me, Jonathan Greenstein, and request them. My email address will be on the screen on the next slide as we cover the questions. Let me end the poll here. And go to the next slide. Brilliant. Now, we've got a lot of questions here, and we're going to try cover off as many of them as quickly as we can. So the first question we have here, with respect to scenarios leading a firm to wind down its business, how many scenarios need to be modeled? For all panelists who are looking to answer this, please can you make sure you unmute your
Yeah, hi Jonathan.
Okay.
Yes, go on, panel.
Yes. Thank you, Jonathan. Sorry about the delay. I was trying to find the mute. There is no specific requirement on the number of scenarios to be concluded in the plan, but it should be proportionate to the size and complexity of each investment firm. There are specific guidelines and instructions on the application of the wind down plan in guidance issued by the FCA.
Thank you very much. So next question. What if any are the implications for appointed representatives?
I'll take that, Johnny. The responsibility essentially will lie with the principal to monitor its ARs and account for their activities accordingly in the widest regulatory sense. In addition, next year we're expecting some new rules following Green Seal, and both the government and FCA will make this clearer in the near future.
Thanks, Peter. We're moving swiftly ahead here. Firms with dealing on own accounts are non-SNI. Is this only the case if the firm has a matched principal limitation?
Yes. Actually, investment firms permitted to act as principal dealers with much principal limitation to their dealing on account investment service will be considered by default non-SNI firms, as they are authorized to offer the dealing on account investment service. And also, just point out that the permanent minimum capital requirement for such firms will be increased to £750,000. This increase, this initial capital will be gradually increased for a transitional period of time of 5 years. In the first year will be the current base requirement. In the second will be increased to £190,000. And for the next 3 years will be increased by £140,000 until the end of the 5th year, where the full permanent minimum capital requirement will become £750,000.
Thank you. Next question here. Please, could you share calculation templates? I'm actually happy to respond to this one. So the templates will be unique to each firm. The risks and the policies each firm will differ, and each firm should ensure that it identifies and mitigates their risks in line with the new regulations. The FCA will want to see evidence of deep thought of risk and mitigation within firms. And the ICARA process will be something that firms should account for in their planning. Now, Complyport can assist firms with the preparation of the ICARAs as well as other things, but we can discuss that later on. Next question is, are you planning to make changes to your risk management framework and taxonomy in order to implement the new IFPR ICARA?
I'll answer that, Johnny. Yes, we've already reviewed the policy statements and consultation papers published by the FCA, and we offer gap analysis based on the new IFPR regime that is tailored to the needs of each client. Moreover, we've also proceeded and adjusted our ICARA templates in order to reflect the latest provisions of the recent policy statements, PS 21.6, 21.9, and the recently issued 2117.
Thanks, Peter. Next question, is there a new spreadsheet to replace the ICAAP?
Yes, Jonathan, the FSA 019 will be replaced by the MiFi Pro 007, as I have included in my slides. That is the ICARA questionnaire. All investment firms will be required to submit this return to the FCA on an annual basis via the Reg Data portal as an XML file where applicable. As I said earlier, the new ICARA questionnaire will be asking questions related to the basis of the ICARA, either solo or consolidated, the key dates such as the reference dates, the review date, and the submission date, the own funds composition, the threshold requirements, additional capital and liquidity requirements, questions related to the wind down plan, and of course, questions regarding the firm's business model and activities.
Thank you. Moving ahead, what are the key next steps MiFID Pro firms should take to ensure compliance with the IFPR?
I'll take that. Essentially, the firm should have systems in place to be able to collect all the data needed for the calculations of the K factors in order to be able to monitor their risk under the new IFPR regime, as well as their classification. Some of the data will need to be collected from today. Also, firms should start preparing for their ICARA process and all the other reporting requirements added under the regime. Finally, the firm should ensure they have in place the technological infrastructure for the new reporting, as submitted files should be in XML format instead of the previous XBRL. Also, firms should update risk management related policies which are affected, and also make sure that firms have the adequate risk management committees and the necessary oversight which the regulations require.
Thank you. How do we identify our group structure is sufficiently simple for being eligible to GCT?
Okay. As I said earlier, there is no specific reference in the final rules regarding the definition of the sufficiently simple group structure. However, all investment firms, all UK parent entities actually, which are interested to apply for the permission to use the group capital test instead of the full consolidation supervision, they need to take into consideration all relevant factors, which will vary depending on the nature of their relevant group. Such factors can be the number and size of the entities, or whether they are any significant numbers of minority shareholders, where the entities within the group are located, and whether those jurisdictions are equivalent to the UK IFPR, and of course also describe the nature of the business undertaken within the group by each entity. Just to mention here, Jonathan, that the application is now available on the Connect portal, and the investment firm groups that will apply until the 31st of January 2022 will benefit from a two-year transitional provision to apply the group capital test instead of full consolidation, or until the FCA come back with a decision.
Fantastic. I think we've only got time for 3, maybe 4 more questions, because we have overrun by about 8 minutes here. It would be good to understand the Pillar 2 changes needed to capture and measure potential harm. Can anyone expand on that a bit?
Yes. Well, the Pillar 2 approach, with the risk to harm in mind, introduces a broader scope to the calculation of the additional risk that is not covered by the capital adequacy requirements. That is the fixed overheads, the K factors, the permanent minimum capital. They should include the definition of harm, how that applies to the business activities. The FCA provides examples in the final rules of Annex 1 in the MiFi Pro 7 to introduce the OFAR, both for capital and liquidity, and also the capital requirements, as I said before, the maximum of the permanent capital, the K factors, and the fixed overheads, and the wind down. And for also the liquidity requirements, also again as the maximum amount of the basic liquidity requirements, and then at the standalone basis and the wind down.
Fantastic. are firms expected to increase share capital to £75,000 and then hold the balance of the requirement as capital reserve?
Yeah, that's a really good question, Jonathan. Upon the implementation of the new prudential framework, all investment firms must have own funds of at least the highest between the fixed overhead requirement, the permanent minimum capital requirement, and of course the key factor requirement where it's applicable, as we explained earlier. Therefore, although there is no need to increase share capital accordingly, so to reflect the new regulatory requirement, the investment firms, all investment firms, must maintain eligible capital instruments such as common equity tier 1, additional tier 1, and tier 2 capital, so to ensure that they have in place adequate own funds to cover these new requirements. So investment firms should assess whether they maintain sufficient own funds so to cover these new IFPR capital requirements, and then decide whether there is any need to increase their share capital, of course, only if needed and not prior to the implementation.
Great. The next question: how to create a wind down planning for a new brokerage firm, or how would you create a wind down plan for a new brokerage firm?
Okay, thank you, Jonathan. For newly established investment firms, the latest business plan, including the projections submitted as part of the authorization application, should be used for the estimation of the wind down plan. Of course, since the firm is still at the beginning of its operations, the assumptions as well as the figures to be used should take into account the size, the nature, the scale of the investment firm, and the assumptions to be used that will be adjusted in line with the short life of the firm.
Thank you. And I think, unfortunately, we're 11 minutes over now. We've got time for one more question. Let's pick one here. I'd like to know more about transition arrangements. Can any of the panelists please expand on and respond to this one?
I'll answer that, Johnny. Look, the FCA have made clear that investment firms with the new capital requirements will have a period of over 5 years, or a period of up to 5 years to meet their new capital requirements. Where we see in certain sections the risks of firms, maybe they're at 125 at the moment, there's a possibility, because of the risk that they pose to the market, the FCA will require them to move to a 750k. So we'll see a period where firms will have to find a substantial sum of money over the 5-year period to meet their 750,000 threshold.
Thanks, Peter. Now, I think that's all the questions we can get through today, but we have got a lot more questions that have come in both before the session started in the run-up over the last few weeks, as well as on today's session, and we will be responding to each one of those by email. I want to let everyone on this webinar know that Complyport can assist firms with their IFPR implementation, the production of an ICARA, as well as the provision of IFPR compliance documentation. As a first step for many firms, we are offering an IFPR impact assessment, which is a gap analysis that will map your firm against the regulation, identifying any gaps needing to be filled by the 1st of January 2022. I'd like to thank all the attendees on today's webinar for joining us for this very interesting discussion. As mentioned at the very beginning of the session, this webinar has been recorded, and we will bring the recording online soon. The recording will be emailed out to all people who attended the session today. And please follow Complyport on LinkedIn to see when it becomes available to watch as well. To everyone, panelists and attendees, thank you very much and have a very good day.